What's going on, you guys? My name is Zach Hartley, and in this video we're going to explore the question of, do the best investors in the world diversify their portfolio? If you get any value out of this video, remember to click that like and subscribe button. Let's jump right in. Okay, so when we are talking about diversifying your portfolio and diversification, let's just clarify what we are talking about first of all. And when I say that word, basically what I mean is building a portfolio with a wide range of investments in different industries, usually with relatively equal weighting. And the idea behind diversification is building a portfolio that isn't going to be kind of run up or down by one individual security. So if you had a very diversified portfolio, it might be 10 different stocks in 10 different industries, all at 10% weight within your portfolio. That's what a very evenly balanced and diversified portfolio might look like. And so my question and what we're trying to figure out in this video is, do the best investors in the world actually diversify their own personal portfolios? Now, luckily, most of the best investors in the world have to publicly disclose their own personal portfolios and their investments. So we can actually take a look at this, and in this video, we're going to dive into 4 of the best investors that in my head, these are the 4 guys that have really kind of led the pack and set the trend over the last sort of 20 to 30 years. And so these are the people that I look up to, and we're going to dive into their portfolio right now to see if they actually diversify or what their personal portfolios really look like. So the first person we're going to start with here is Warren Buffett, the Oracle of Omaha. He is the founder and the chairman of Berkshire Hathaway, which is basically a holding company, an investment company, and that is where all of Warren Buffett's money is. It is in Berkshire Hathaway. That's pretty much the only stock that he owns, because Berkshire Hathaway owns stocks underneath it. And Warren is kind of the guy that handpicks Berkshire's investments. And so for Warren Buffett, we're actually going to take a look at what is within Berkshire Hathaway. And when we take a look at what Warren has decided to own through Berkshire Hathaway, it's very, very interesting, because his number one holding here is Apple Incorporated. So Apple, the big tech giant that everybody knows. And currently, Apple makes up 47.6% of Warren Buffett's Berkshire Hathaway portfolio. And so when you look at this, you say, okay, it's 47% here, and then the next largest holding is 13.58, and then the next largest holding is 7.5, and then it kind of drops down to like 2 and 3 and 1%, and he's got a bunch of holdings that are around 1% or less. And so what's really interesting here is that almost half of Warren Buffett's portfolio is made up of Apple. And so no, that is not a diversified portfolio. That's not really diversified in any way. Maybe you could say they're in different industries here, but when 47.6% of your portfolio is in one security in the technology industry specifically, I would not classify that as diversified. Now, the second person here is Bill Gates. This is the old founder and CEO of Microsoft. Now he does a whole lot of different things, including philanthropy as well as managing his own portfolio. And what's crazy about Bill Gates' portfolio is that 45% of his holdings are actually in Berkshire Hathaway, which is the company we just looked at, which has 47% of its holdings in Apple. And so if you do the math here, Bill Gates, who is the founder of Microsoft, actually probably owns more Apple than he does Microsoft. Microsoft makes up 3.57% of his portfolio, but 45% of his portfolio is Berkshire Hathaway, and 47% of Berkshire Hathaway, 47.6% of Berkshire Hathaway is Apple. And so Bill Gates here probably owns more Apple stock than he does Microsoft, and 45% of his holdings are in just Berkshire Hathaway. Now, the third investor I want to talk about here is Carl Icahn. This is one of the most famous investors from throughout the last 20 years. He's done extremely well for himself, and he's definitely probably the top 5 best investors of all time. And 54.8% of his portfolio is in his own company, Icahn Enterprises. Very similar to Berkshire Hathaway, but what blows my mind here is that he has one security that makes up 54% of his portfolio. The next largest security is 7%, and then 5.9, 5.2. And so Carl Icahn is really kind of following the similar trend here. And the last person that I really like is Peter Lynch. Now, Peter Lynch, his portfolio isn't publicly available anymore, but he is one of the best investors from kind of the 80s onward. And he's really, really smart guy. You have to watch his interviews on YouTube if you haven't seen them. But here's what he says about diversification. He says there's no point in diversifying just for the sake of diversifying. So there's no point in owning 100 stocks just for the sake of being diversified. It doesn't give you any benefit if you're just doing it to be diversified. He says that investors should own however many exciting prospects that they are able to uncover that pass all the tests of research. And so what he's basically saying here is that you should only own as many stocks as you are actually excited about, that pass all of your research, and that you can actually follow, do due diligence on, and stay up to date with. And for most people, me at least, that's usually in the range of 5 to 10. It's nothing more than that. And usually what happens is if you make that decision and you go for your 5 to 10, after a few years, one of them usually rises to the top. And after a few years after that, you're probably not going to have a diversified portfolio anyway. And so Peter Lynch, very smart guy, definitely watch some of the interviews with him. But basically the 4 investors that I pointed out to you here are some of the best investors from throughout the last 50 years, and almost none of them hold an equally balanced, diversified portfolio. In fact, 3 out of 4 of them have their largest holding well above 40%. And so very, very interesting trends that we are seeing here. Now, when you start to dive into these people and you start to ask them, why don't they diversify? What's the methodology and the theory behind it? Here's what Warren Buffett says. He says that diversification is protection against ignorance. It makes little sense if you know what you are doing. And this is very similar to actually what Peter Lynch said here. He's basically saying that if you know how to research and analyze these stocks, you should be able to go through the S&P 500 and say, hey, these companies don't fit into what I'm looking for, and they don't fit into the category of a great company that I want to invest into. But these ones up here do, and I'm going to choose a couple of them that really fit my portfolio, my investing style. And more than likely, if I choose well enough and I do enough research, those stocks are probably going to outperform the average. So that's what Warren Buffett is saying here. If we go on, we can see William J. O'Neill. He was actually the author of a very famous book, How to Make Money in Stocks. It was published back in the late 80s, and since then it has sold over 2 million copies. He says that the winning investor's objective should be to have 1 or 2 big winners rather than dozens of very small profits. And basically the reason behind this is because more than likely you're not going to be able to capture a whole bunch of 10 and 15% profits. You're probably going to be able to find 1 or 2 really good companies, though. That's not going to be super difficult compared to finding 10 decent companies. And so William J. O'Neill basically says that you should focus on trying to find a couple of specific really good winners. And then lastly here we actually have Benjamin Graham. He was Warren Buffett's kind of mentor, and this is kind of how Warren got started. And he says he's also actually the author of The Intelligent Investor, one of the best investing books that you could possibly buy for your money. And he says that the determining trait of the enterprising or successful investor is his willingness to devote time and care to the selection of securities that are both sound and more attractive than the average. This is super important here because if you diversify your portfolio and you buy an ETF, you're going to get the average. But even Benjamin Graham knows and talks about the ability to devote time and care to the selection of your securities that should give you a better than average return. And in this specific sentence here, he's talking about focusing on specific securities, putting them through the ringer and all of your due diligence to try and find better investments than the average here. Now, in summary, basically what I'm trying to say here is if you have the time and the knowledge to invest into research and due diligence, then diversification may not be the best strategy. You may have an opportunity to generate better than average returns, but it's also obviously not guaranteed. However, if you do not have the time or the knowledge, then an ETF or a simple diversified portfolio is probably a great option. So if you plan to work a full-time job and that's how you're going to generate income and you just need to save and kind of build up some wealth, diversification, long-term ETF, S&P 500, definitely the way to go. But if you look at the best investors that are out there that have done this for a very long time, it does not seem like, it does not appear like, and they definitely don't talk like diversification is the best strategy out there. Now, if you're interested in learning more about this specific topic, as well as how to actually balance a portfolio, manage a portfolio, and get started in the stock market, then definitely check out my completely free course. It is hosted on Skillshare, and you get 2 weeks of free access when you use the link in the description down below. There you can take my 10-hour course. If you can do the entire thing in under 2 weeks, cancel your subscription, cancel that free trial, and you won't pay a single dime. Now, the nice thing about Skillshare is that during that 2 weeks, you also get access to all of the other courses on the platform, which is really nice. My particular course has over 11,000 students that have already gone through it. There's 380 reviews for you to take a read through. There's 1.6 million minutes of watch time. And like I said, it's hosted on Skillshare, very, very reputable platform. The link is in the description to this video. And it's a totally free resource, so I hope you take advantage of it, try it out. You will have to put your credit card in to create an account, but like I said, you get like either 2 weeks or 1 month completely free, and it's so worth the time and the effort. I take a course on there like literally once a month, and if you're interested in seeing a full article that I wrote about this specific topic, I posted it to my LinkedIn. I will also put a link down below where you can read it. It's like 3 pages long, and it goes into a little bit more depth, especially about the people I talked about here, and in particularly Warren Buffett. So if you want to see that, everything will be down below, and thank you so much for watching till the end. I sincerely appreciate it, and we will see you in the next video. Good luck trading, good luck investing, and we'll talk to you soon.